Look, I'm going to be straight with you. While everyone's distracted by holiday shopping and year-end planning, something massive is unfolding in the precious metals market. And if you don't act before this Friday, you might miss the easiest entry point we've seen in months. Let me paint you a picture of what's happening right now. Silver just hit another all-time high. Not a typo. All-time high. And gold? It's climbing steadily despite real interest rates being at their highest level in 18 years. Think about that for a second. Traditionally, when real rates go up, gold should go down. That's economics 101. But it's not happening. In fact, the opposite is occurring. That tells you something fundamental has shifted in the market. Central banks are buying gold at a pace that's frankly unprecedented. We're talking over 1,000 tons for the third consecutive year. India, Turkey, Poland, they're not just buying, they're hoarding. And they're doing it quietly, methodically, like they know something the general public doesn't. Here's what most people miss. When central banks buy gold, they're not speculating. They're not trying to make a quick profit. They're protecting their national reserves against something they see coming. These are the same institutions with access to economic data you and I won't see for months. They have teams of analysts, direct lines to other central banks, and a bird's-eye view of the global financial system. And they're loading up on physical metal like there's no tomorrow. Now, let me tell you about the supply side, because this is where things get really interesting. The mining industry is struggling. Production costs are rising. New discoveries are declining. And the easy-to-mine deposits, they were exhausted years ago. What we're left with is increasingly expensive extraction from deeper, lower-grade ore bodies. Meanwhile, industrial demand for silver is exploding. Solar panels, electric vehicles, 5G infrastructure, all of these technologies require significant amounts of silver. And unlike gold, silver gets consumed. It doesn't sit in a vault waiting to be recycled. It gets used up in industrial applications where recovery is economically unfeasible. Think about the solar industry alone. Every solar panel requires about 20 grams of silver. With the global push toward renewable energy, we're talking about hundreds of millions of panels being manufactured annually. That's thousands of tons of silver being permanently removed from the available supply. And this demand is only accelerating. But here's where the story gets even more compelling. The paper market versus the physical market. Most people don't understand this distinction, and it's absolutely critical. When you see gold and silver prices quoted on financial news, those are paper prices. Futures contracts, ETFs, derivatives, these are essentially promises to deliver metal. But here's the dirty secret. There's far more paper metal trading than there is actual physical metal in existence. Some estimates suggest the ratio is over 100 to 1. That means for every ounce of physical silver that actually exists, there are over 100 paper claims on it. What happens when people start demanding physical delivery? We've already seen glimpses of this. Premiums on physical metal have been spiking. Delivery delays are becoming common. Dealers are struggling to source inventory. This is the early stage of what could become a full-blown supply crisis. Let me take you back to a similar situation. In 1980, the Hunt brothers tried to corner the silver market. They accumulated massive positions, and as they took physical delivery, the price skyrocketed from around $11 to over $50 per ounce in just a few months. Now, I'm not suggesting we'll see that exact scenario play out again. But the underlying dynamics, paper claims exceeding physical supply, are remarkably similar. Except this time, it's not two brothers. It's central banks, institutional investors, and millions of individual investors worldwide, all waking up to the same reality. The geopolitical situation adds another layer to this. We're watching a slow-motion de-dollarization unfold. Countries are settling trade in their own currencies. The BRICS nations are discussing a gold-backed trade currency. Saudi Arabia is accepting yuan for oil. These aren't random events. They're coordinated moves away from dollar dependence. And what's the alternative to fiat currency? Historically, it's always been precious metals. Here's something that should concern every American. Our national debt just crossed $36 trillion. That's trillion with a T. The interest payments alone are becoming unsustainable. We're in a situation where the government has only two real options: default or inflate. And I can tell you which one they'll choose. They'll print, they'll inflate. Because defaulting would be political suicide and would destroy America's credibility overnight. But inflation? That's a slow, hidden tax that most people don't fully understand until it's too late. When inflation really kicks in, and I mean real inflation, not the manipulated CPI numbers, people rush to hard assets. They rush to things that can't be printed, that have intrinsic value, that have been recognized as money for thousands of years. Gold and silver fit that description perfectly. Now, let me share something that might be relevant to your situation. If you're sitting on a substantial retirement account, say $100,000 or more in a 401k or IRA, there's a strategy worth understanding. It's called a gold IRA, and it allows you to hold physical precious metals inside your retirement account without triggering tax penalties. I've put together a comprehensive guide on how this works, and it's available in the description below. It covers the mechanics, the benefits, the potential pitfalls, and how to execute it properly. If you're concerned about the purchasing power of your retirement savings, it's worth a look. But let's get back to why this Friday matters. Markets don't move in straight lines. They move in waves, in cycles. Right now, we're in a consolidation phase. Prices have pulled back slightly from recent highs. This is normal, healthy market behavior. But these consolidation phases don't last forever. And when the next leg up begins, and all the technical indicators suggest it's imminent, you don't want to be on the sidelines wishing you'd acted. Look at the chart patterns. We're seeing a classic bull flag formation in both gold and silver. For those unfamiliar with technical analysis, a bull flag is a continuation pattern. It means the previous uptrend is likely to resume after a brief pause. The volume patterns support this. We're seeing declining volume during the consolidation, which is exactly what you want to see before the next breakout. The COMEX data is equally telling. Commercial traders, the big banks and institutions, have been reducing their short positions. These are the smart money players. They don't reduce shorts unless they expect prices to rise. Meanwhile, large speculators have been adding to long positions, but not excessively. We're not in bubble territory yet. There's still plenty of room for this rally to run. Let me tell you about something called the gold to silver ratio. Historically, this ratio has averaged around 15 to 1. That means it took 15 ounces of silver to buy 1 ounce of gold. Right now, that ratio is much higher, around 80 to 1. This suggests that silver is significantly undervalued relative to gold. When this ratio normalizes, and it always does eventually, silver prices could explode. We're talking about potential gains that could dwarf what gold delivers. Think about the implications. If gold goes to $3,000 per ounce, which many analysts consider conservative, and the gold to silver ratio returns to its historical average, silver would need to be at $200 per ounce. That's roughly an 8-fold increase from current levels. Now, I'm not making predictions or guarantees. Markets are unpredictable, but the mathematical potential is undeniable. Here's another angle most people overlook: the velocity of money. Right now, despite massive money printing over the past few years, much of that money is sitting in bank reserves. It's not circulating through the economy, but that's changing. As banks start lending more aggressively, as that money enters circulation, we could see inflation accelerate rapidly. And when that happens, precious metals typically surge. We saw this play out after the 2008 financial crisis. The Federal Reserve launched quantitative easing, essentially printing trillions of dollars. Gold went from around $800 per ounce to over $900 in just 3 years. Silver went from $9 to nearly $50. Those weren't small moves. Those were life-changing gains for people who positioned themselves correctly. But here's the thing. Most people waited. They watched the early stages of the rally, convinced it couldn't continue. They waited for a pullback that never came, or when it did come, they were too scared to buy. By the time they finally jumped in, the rally was nearly over. Don't be that person. The current setup is arguably even more favorable than 2008. Back then, we were dealing with a banking crisis. Today, we're dealing with a sovereign debt crisis, a currency crisis, and a geopolitical realignment all happening simultaneously. The scale of money printing required to address these issues will make 2008 look like a warm-up exercise. Let's talk about China for a moment. They've been accumulating gold for years, but recently they've accelerated their purchases. Why? Because they're preparing for a world where the dollar is no longer the undisputed reserve currency. They're building an alternative financial system, and gold is the foundation. When the world's second largest economy is betting this heavily on gold, you should pay attention. Russia is doing the same thing. After being cut off from SWIFT and having their dollar reserves frozen, they learned a harsh lesson about the weaponization of the dollar. Their response? Buy gold. Lots of it. They've been converting their dollar reserves into gold at an aggressive pace. And they're not alone. Countries around the world are realizing that holding dollars makes them vulnerable to U.S. foreign policy decisions. This is creating a fundamental shift in global finance. For 70 years, the dollar has been the world's reserve currency. That status gave America enormous privileges: the ability to run massive deficits, to print money without immediate consequences, to essentially export our inflation to the rest of the world. But that era is ending, and when it does, the dollar's purchasing power will decline significantly. What will hold its value? Hard assets, precious metals, real things that can't be printed or manipulated. Now I want to address something important. Some people will tell you that gold and silver don't pay dividends or interest. They'll say you're better off in stocks or bonds. And in certain market environments, they might be right. But we're not in a normal market environment. We're in an environment where central banks are trapped. They can't raise interest rates without crashing the economy and the government's ability to service its debt. But they can't keep rates low without fueling inflation. They're stuck between a rock and a hard place. In this environment, the traditional 60-40 portfolio of stocks and bonds doesn't work. Both assets are vulnerable. Stocks are overvalued by almost every historical metric. Bonds are guaranteed to lose purchasing power if inflation accelerates. Where do you go? You go to assets that have preserved wealth through every financial crisis in human history. You go to gold and silver. Let me share a story that illustrates this point. In Weimar Germany during the hyperinflation of the 1920s, people who held paper currency were wiped out. Life savings became worthless overnight. But people who held gold, they not only preserved their wealth, they were able to buy real assets, property, businesses, at fire sale prices from desperate sellers. The same pattern played out in Zimbabwe, in Venezuela, in Argentina. Every single time a currency collapses, precious metals preserve wealth. Am I saying the dollar is going to collapse next week? No. But am I saying the long-term trajectory is concerning? Absolutely. And the smart money is already positioning for this. They're not waiting for the crisis to hit. They're preparing now, while prices are still reasonable, while supply is still available. Here's what most people don't understand about precious metals. They're not an investment in the traditional sense. They're insurance. They're a hedge against the failure of the monetary system. You don't buy gold hoping to get rich. You buy gold to make sure you don't get poor. And right now that insurance is relatively cheap. But it won't stay that way. The supply constraints I mentioned earlier are real and getting worse. Major mining companies are reporting declining production. Exploration budgets have been slashed. It takes 7 to 10 years to bring a new mine online, even if you discover a significant deposit today. Meanwhile, demand is accelerating. This is a recipe for a supply squeeze that could send prices parabolic. And here's the kicker. When the general public finally wakes up to this, when your neighbor, your coworker, your uncle at Thanksgiving dinner starts talking about buying gold and silver, it will be too late to get in at reasonable prices. The premiums will be astronomical. The wait times will be measured in months, not days. The dealers will be sold out. We've seen this before. In 2008, during the financial crisis, premiums on silver coins went from $2 over spot to $8 over spot almost overnight. Dealers couldn't keep inventory. Mints couldn't produce coins fast enough. And that was just a banking crisis. Imagine what happens during a full-blown currency crisis. This Friday represents a decision point, not because the world ends on Saturday, but because we're at a technical and fundamental inflection point. The consolidation is ending. The next leg up is beginning. And you're either positioned for it or you're not. Think about your financial situation. How much of your wealth is in paper assets? How much is in things that can be printed, manipulated, or devalued by government decree? If the answer is most of it or all of it, you have concentration risk. You're betting everything on the continued stability and integrity of the financial system. Is that a bet you're comfortable making? I'm not suggesting you sell everything and buy gold and silver. That would be foolish. But I am suggesting that having zero exposure to precious metals in the current environment is equally foolish. A balanced approach, maybe 10 to 20% of your portfolio in physical metals, provides insurance without requiring you to bet the farm on any single outcome. And here's something else to consider: the psychological aspect. When you own physical gold and silver, you own something real. You can hold it. You can see it. It's not a number on a screen that could disappear if a bank fails or a brokerage goes under. There's a peace of mind that comes with that. In uncertain times, peace of mind is valuable. The technical setup right now is textbook. We have strong fundamentals: central bank buying, supply constraints, currency debasement, geopolitical instability. We have favorable technicals: bull flag patterns, declining volume on pullbacks, commercial traders reducing shorts. We have sentiment that's not overly bullish yet. The general public isn't piling in, which means we're not at a top. All the pieces are in place. But timing matters. Markets can stay irrational longer than you can stay solvent, as the saying goes. However, they can also move faster than you can react. When gold breaks through its next resistance level, when silver starts its parabolic move, you won't have time to research, to deliberate, to wait for a better entry point. You'll be chasing, buying at higher prices, competing with everyone else who finally figured it out. The smart money acts before the crowd. They accumulate during consolidations. They buy when prices are boring, when nobody's talking about it, when CNBC isn't running breathless segments about the gold rally. That's when you get the best prices and the best selection. Right now, you can still buy at reasonable premiums. You can still get delivery in a reasonable time frame. You can still choose from a full range of products: coins, bars, different sizes, different mints. But that window is closing. Every day, more people are waking up to what's happening. Every day, more capital is flowing into precious metals. Every day, the supply gets a little tighter. I want you to imagine two scenarios. In the first scenario, you act this week. You allocate a portion of your portfolio to physical gold and silver. 6 months from now, prices have doubled. Your metals position has provided significant gains and protected your purchasing power while other assets struggled. You feel smart, prepared, ahead of the curve. In the second scenario, you wait. You tell yourself you'll buy on the next dip. But the dip doesn't come, or when it does, you're still not ready. 6 months from now, prices have doubled. You're kicking yourself for not acting when you had the chance. You're paying twice as much for the same ounce of metal. You're competing with desperate buyers. You're waiting weeks or months for delivery. Which scenario do you want to be in? The choice is yours, but the window to make that choice is narrow. This Friday isn't arbitrary. It's the end of the consolidation pattern. It's when the technical indicators suggest the next move begins. It's your last chance to position yourself before the crowd figures it out. Look, I understand hesitation. I understand wanting to do more research, to think about it, to wait for the perfect moment. But in markets, the perfect moment rarely announces itself. It only becomes obvious in hindsight. The people who make life-changing gains are the ones who act on incomplete information, who trust their analysis, who have the courage to move when others are paralyzed by uncertainty. The data is clear. The trend is clear. The setup is clear. What's not clear is how much time you have before this opportunity passes. My best guess, based on decades of watching these markets, is that you have until Friday. After that, we're likely in the next leg up, and entry points will be significantly higher. So here's what I want you to do. Take an honest look at your portfolio. Calculate how much you have in paper assets versus hard assets. Think about what happens to those paper assets if inflation accelerates, if the dollar weakens, if the financial system experiences another crisis. Then ask yourself, am I comfortable with that exposure? Am I adequately protected? If the answer is no, if you feel that knot in your stomach that tells you something's not right, then act. Don't overthink it. Don't wait for permission. Don't wait for the perfect moment. Take a reasonable position in physical gold and silver. Not paper ETFs, not mining stocks. Physical metal that you can hold in your hand or store in a secure vault. And if you're concerned about the mechanics, how to buy, where to store, how to integrate this into your retirement planning, that's what the guide in the description is for. It walks you through everything step by step. It answers the questions you didn't even know you had. It gives you a roadmap for protecting your wealth in an increasingly uncertain world. The bottom line is this: we're at a critical juncture. The precious metals market is setting up for a significant move higher. The fundamentals support it. The technicals support it. The smart money is already positioned. The only question is whether you'll join them or watch from the sidelines. You have until Friday. After that, the easy money is gone. The obvious entry point has passed. You'll still be able to buy gold and silver, but you'll be paying more and getting less. You'll be reacting instead of anticipating. You'll be following instead of leading. Don't let that happen. Don't be the person who looks back 6 months from now and says, "I knew I should have bought." Be the person who acts on their convictions, who trusts their analysis, who has the courage to move when the opportunity presents itself. The clock is ticking. The market doesn't care about your hesitation or your fear. It moves based on supply and demand, on fundamentals and technicals, on the collective actions of millions of participants worldwide. And right now, all of those factors are pointing in one direction: higher prices for gold and silver. Your move, your decision, your financial future, make it count.